Why are we here? We are here because we are interested in quant trading. So why are we interested in that? Because the North Star in quant trading is Jim Simon's Medallion Fund, right? We all have heard how they generated 66% annualized returns pre-fees over 30 plus years. If we talk about just for 30 years, $1 invested at 66% returns turns into $4 million. Jim Simons laid, let's say, this path and made it very clear and visible for everybody that yes, you can use math, you can use statistics, you can use scientific methods on the markets and beat the markets. You can generate much higher returns. People talk about Warren Buffett. Warren Buffett's returns have been in the 20s when it comes to annualized returns. These guys at the Medallion Fund delivered more than 60% returns. Why does that interest us? Because we understand that money makes the world go round. Most people here end up trading their time for money often. We would be doing jobs where we spend our time and then we get a salary at the end of the month. And we are all always interested about how to make more money or how to grow our money more efficiently. And quant trading is a pretty good area to focus on if that is what interests you. Why? Because quantitative jobs are very high paying jobs. We know that sometimes portfolio managers, they can make even millions of dollars at quant funds, obviously, because if you can generate 66% returns, why not? And also, if we want to grow our money, all of us, let's say, are interested in investing. But what if there is something that is better and can grow our money a lot more efficiently, generate higher returns with lower risks? Why would we not be curious about that? It's not just about the money. A lot of people, they love numbers, they love coding, they like building complex systems. They want to make a machine that can just be, let's say, making money while they sleep. Not again because of the money, but because they like the thrill or challenge of it. Another thing that I've seen with people is that they like the fact that the problem statement is very well defined. We have a very straightforward data set. Usually people use the OHL CV data, which is open, high, low, close volume data. You can use it for as many years as you want for whatever asset class or index you want. And the problem is that how do we generate high returns with minimal risk from the markets? And quant finance is this ultimate math plus data science plus computing playground where you could do a lot of these things. It is worth pausing here and thinking about what about investing, right? We have all heard about investing. We know that that is one way to grow money. And why then focus on trading? What about the fact that trading can be more risky than investing? We do these 3-hour webinars. We've done them by like 4 times by now over the past 6 months. Every time we do them, we do a poll asking people, what do they think? Is trading more risky or investing more risky? 80% of people say that trading is more risky. And the thing is, it's actually a trick question because what kind of trading are we talking about? Are we talking about retail trading or quant trading? And if you're talking about retail trading, then yes, retail trading is more risky than investing because what retail traders usually are doing is gambling. Like it's almost like going to a casino. You know, the house has the edge. That's why casinos exist. They're not charities giving away money for free. In the short term, it might feel like you could win, but in the long term, the more you play at a casino, the more you lose. And that's why 80-90% of retail traders mostly lose money. But when we compare investing and quant trading, something different emerges. When we think about investing, a lot of times people talk about investing in equities because equities generate, let's say, the highest returns among asset classes over tens or even 100 years. But we know that when it comes to investing, you have to be open to tolerating maybe 30 to 50% drawdowns, right? For example, in 2008, in the financial crisis, most of the indices were down 50%. And what usually happens in investing is that people are focusing on maximizing returns only. Whereas in quant trading, the focus is on maximizing risk adjusted returns. What we are trying to do is how can we get the returns without a lot of the risk? How can we still make high returns, maybe the 10, 12% that on average you can make in equities, but without the 50% drawdown, maybe much lower drawdowns, let's say 4% drawdown. And so what you end up building is this system which manages the trades, which figures out what are good enough entry times and good enough exit times, not just ride the markets all the time, but get in, not again at the bottom and exit at the top, but close enough. And I'm simplifying it too much. That's let's say simplification of what is trend, which is a factor in the markets, but there are many other factors in the market, and we'll talk about that also. But one way to compare what is more risky or less risky, or compare investing versus trading, is Kalmar ratio. What is Kalmar ratio? It's the annualized returns divided by max drawdown. So now if we think about it, equity indices, they on average, let's say they give 10% returns. But when it comes to drawdowns, they give 50% drawdowns a lot of times. S&P in 2008, 2009, it gave a 51% max drawdown. So the Kalmar would be 10% divided by 50%, which would be just 0.2. But when it comes to quant trading, Kalmars of 5 plus are considered good. And how do you do that? How do you get that? So for example, if you had a strategy that generated 25% returns at only 5% max drawdown, you would have a Kalmar of 5. And then an interesting thing comes up, that if your drawdown is only 5%, where everybody else is fine with even 30% or 20%, why not leverage your strategy, right? Why not go 4x or 5x? If you can do 25% returns with 5% drawdown, why not 4x that? And then you can get 100% returns with only 20% drawdown. And that's still better than equities. And that's how quant trading ends up being a lot less risky than investing. And this is, let's say, what the return profiles can look like. It might look very crazy that, okay, how can in 8 years, 2000% or close to that returns be generated? But that's compounding in place. If you look at it just with, I guess, 40% returns every year, you would end up getting to 2000% overall return over 8, 9 years. Now, we understand that we want to get into quant trading and we might be interested in becoming a quant, but what paths are available? And there are two kinds of paths, I would say. One is the campus hire path. Let's say that's the path that I went through. In my schooling times, I was interested in math and computer science, and I got into IIT. I got a good enough rank, and yet it was not, let's say, good enough to get computer science in IIT Delhi. So I ended up doing electrical engineering and computer science, BTech plus MTech, which is a dual degree. And then I saw that because I'm in electrical engineering, I couldn't, let's say, get into Facebook or Google or Microsoft. But there were these companies called quant companies or finance companies, which had these quant roles like Goldman and World Quant, etc. And those roles seemed pretty lucrative and actually a lot more interesting when I learned about them, because you could use not just computer science, but mathematics, and also apply it on finance, which is a pretty interesting area. Through my campus placements, I got both offer from Goldman and World Quant apart from other companies, and I decided to go to Goldman as a quant. Now, this is like a fast track path, right? But it requires you to be, let's say, in a top school, make sure you have a relevant degree, and you might also need to do a very rigorous prep for these interviews. I graduated in 2012. Things are even crazier now. But a lot of us don't have a time machine. Maybe we can't go back to, say, 15, 16 and enter a grade school or pick a more relevant degree. That does not mean that it's not possible, because there's another path, and we have Sam on the call, and let's look at what path Sam followed, right? He did a non-quant major. He didn't learn math or CS in that major, but when he graduated, he ended up getting a coding job. He was not necessarily that interested in coding at that point, but he ended up learning coding, and now he loves coding. And then from there, he got into an investment bag. He got then into a trading role in the bank. Eventually, he jumped to an asset manager, then to hedge fund, and now he's an independent quant, managing more than $50 million of client money. So that kind of shows that, this is not just a 3-month step function journey that today you decide to be a quant and then 3 months later you end up becoming a quant. And that's why if you even hear about boot camps that will in 3 months guarantee you that you will hack into a hedge fund quant role and get the job, most likely it's snake oil, right? And if you have $5,000 to pay for it, sure, go ahead. But probably doesn't make sense. What is more sensible potentially is to think about this in terms of steps, in terms of stepping stones and breaking the journey down. But just jumping around in jobs is not what Sam did. He deliberately learned the most important skill for getting quant roles, and that is quant research. We talked about hedge funds. Now they hire quants, and what these quants do is that they observe the markets. They look at the market charts and the market data, and they come up with a lot of observations. And based on these observations, they come up with a lot of ideas and that they convert into hypotheses. And then they write them down and code them up. And then they apply all these, let's say, hypotheses, or they run this code on 10, 15, or even more years of data. This process is called backtesting, right? And then looking at the backtesting results, they continue the validation, they have some robustness checks, and eventually then things go into deployment. They might be paper traded first, then live traded at the beginning with small amounts of money, and then over time with more and more money till, let's say, it hits capacity. And throughout this process, everything is getting monitored very closely. And that's what happens in hedge funds, quant funds. That's what quants do. And what kind of skills are needed for this? Coding skills, math skills, some finance skills. But that's not enough, right? Even if you do a 4-year computer science degree, a 4-year math degree, a 4-year finance degree, you might still not know anything about how to build a trading strategy. Because there's all these other things, like how to come up with ideas, how to backtest them properly and robustly, how to validate all these ideas, how to then build an execution system, a lot of which is not taught anywhere. If we have to compare what are some of the common pitfalls, here are some of the pitfalls, right? Even after learning a lot, when people sit in front of, let's say, their laptop or computer to build a strategy, they don't have any ideas. A lot of times, what retail traders, for example, do is they will look at 2 or 3 months of charts and they would come up with one idea and then they'll straight away start trading it and then obviously lose money because it's not that easy to make money. In all these hedge funds, all the quants, they are generating more than 200 ideas every year. Another issue is poor data handling. People don't know how to handle data issues, how to clean up the data. A lot of times iteration cycles are slow. We have talked about how in quant funds, they come up with more than 200 ideas a year. That means that you have to try out almost an idea a day. Whereas a lot of times when people are backtesting or coming up with an idea, they'll backtest and then they'll paper trade and then they'll live trade. And 2, 3 months later, they'll realize, oh, this doesn't work. And that's a lot of times because they are doing backtesting incorrectly. They'll, let's say, go to YouTube or to ChatGPT and they learn backtesting there. And there are a lot of gaps still in those kinds of backtesting code bases. Another big thing is people overfit. And there are so many ways of overfitting. For example, just looking at 3 months data or just looking at one index or let's say not knowing how to do some things like sensitivity analysis, etc. And what I've often also seen is there's this urge to go live immediately because there's this lust for money. There's this thing that, okay, oh, I think this will work. Let me just go ahead. Maybe also because they do backtesting incorrectly and they see a Sharp of 3. And that's not actually true because they coded it incorrectly or there are some issues like overfitting and they just go straight to the markets and then end up losing money. Let's talk more about the quant industry now that we know all these things, right? We've talked about hedge funds hire quants. Each quant tests 200 plus ideas a year. There are also this thing that people don't know a lot about, which is the allocator business. There are a lot of people who have a lot of money who are actually looking for quants all the time. When we think about becoming a quant, a lot of times we think about, oh, let me get a job, let me go work at a hedge fund. And that ends up being then us entering in a competition where we are running behind these companies to give us jobs. But there is a situation where actually companies run behind people, and that's when there is money. And there's a lot of money. There's around $20 trillion that are traded every day. All of that money is looking for good money managers. And if you think about quants, quants are money managers on steroids. So there's not just quants working in companies as, let's say, employees, there are also quants working as independent quants. And that's, for example, what Sam is, right? Sam is an independent quant. He's not working for any company, he's working for himself. He has client money, he has more than $50 million that he's managing, and then he makes money for the clients, and then he gets a cut of the money that he generates for his clients. One other thing that is important to understand about the quant industry is that all these strategies that we build, they have capacities, right? If let's say if you have a strategy that can make 100% returns with max drawdown of 20%, why not run it on all the $20 trillion that are traded every day? Because you can't, because you will move the markets much, much before that, and your strategy will actually start losing money. That's because strategies have a capacity. Particular strategy, based on how it is built, you might only be able to trade it on $10 million or $100 million or $1 billion. And beyond that, it doesn't work, which is why these strategies are also very valuable IP. The more you share them, the more your alpha gets killed, which is also why you should be very careful about trusting people when they say, hey, I have this strategy, I'm going to share this strategy with you, and then you can make money, or people putting their strategies on Instagram. Because the more people that it gets shared with, the less money each person can make from this strategy, which also means that public information, right, these technical indicators, etc., they don't have any alpha. So how then can QuantYog help, or why does QuantYog exist? Why are we all here? To tell you about QuantYog or what we are trying to do in QuantYog, I'll have to tell you a bit more about my story. So I told you that I got into Goldman, but I was there in Goldman in Bangalore for 4 years, and then I went to JP Morgan for 5 years in London and ended up becoming an executive director there. And I'd been working all this while in these banks. And when you are working in the finance industry, when you're already in there, you actually can't do a lot of your own trading. You are not allowed to deal in your own personal accounts. And anyways, because of COVID, I had kind of gotten fed up with how the banks handle their employees. So I thought, let's go to tech. I'd always wanted to get into tech companies also. So I went to Facebook, I went to Google, I worked there for a few years. That also allowed me to do my own trading on the side. Then came a point when I thought that, you know what, I think I have enough money. I don't need to work as an employee. So I decided to retire from this life of employment, and I actually moved back to India. And then I later found out that, okay, this thing is called FIRE, like financial independence, retire early. And so I posted about this on one of the subreddits, and that story ended up getting very viral. And many people then started coming to me and they started asking, okay, how can I become a quant? Because they realized that because I started as a quant in 2012, I started at a salary of 32 lakhs, which was very high. So people ask, how can I become a quant? People asked, how can I learn to trade profitably? People asked, how can I retire early? And from my perspective, I thought there's a common theme across all of this, which is that people should learn quant trading. And when I came back to India, one of the biggest things I wanted to do was also that I wanted to work in the education space. So I then reached out to Sam. Sam and I had a conversation and we thought that, okay, you know what, let's start something, because anyways, we used to send reels to each other of all these influencers talking complete nonsense. And we were getting fed up of looking at that stuff also. So we started this. We were a bit skeptical that, okay, we don't know how people find it. Would they be interested as much in quant trading? Would they be willing to put in the effort? And so on. But we started with an Instagram page. We started posting, followers started coming, they started messaging us, asking us questions. So we thought that, you know what, let's just do some one-on-one consultations. So we did free consultations with people. And then we realized that there are a lot of myths in this space. So we got a list of a lot of these myths and a lot of these things that people ask. And so we then started doing these 3-hour webinars. And we have done that a few times. So that's a lot of stuff that we have done more from the perspective of public education. But then there are people who want to go much deeper. They want us to help them even more. They want to build their own trading strategy. They want to learn how to backtest. They want to learn how to come up with ideas. So we thought that the only way that we can probably do, we can't sit and teach everybody one by one. The only way we can maybe do that is by making a course. where we can put all of this information in a structured format so that people can actually do that very affordably, and we can also scalably help people. We started building a community. We have these groups where people ask questions, we answer it, or now people are able to answer questions for each other. They are able to learn on a scalable basis. So that's what we are doing. But our goal is primarily teaching how hedge funds trade, which is basically quant research, because 80-90% of the alpha comes from quant research, which is building these strategies. And then there's 10-20%, which is in execution and portfolio management. If you're interested in the public education, we are by now present on Instagram, we are on Reddit, we are on LinkedIn. We still do these complimentary one-on-one consultations. We have the 3-hour webinar. All of you should already have a link to it because all of you have already registered by now. So you can see that actually in the meeting invite. And now we are even doing this 1-hour live Q&A because we understand that people have seen the webinar, or sometimes people find the 3-hour webinar a bit long. So we thought we can summarize it. So now we are doing this 1-hour live Q&A. So we are doing all this stuff, but then there are also paid one-on-ones. Sometimes some people have some urgent requirements. They have been already building strategies for a few years. So we do paid one-on-ones with them, but they can be very expensive. The minimum starting point is $250 per hour. But then there are courses where the price is a lot cheaper at a per hour basis. And now increasingly, we are starting to do corporate engagements also, where companies who have a lot of traders, they just want us to teach all of their traders. Now, moving on, one thing that I want to talk about is Sam's journey. We talked about how there were stepping stones, he moved from one role to the other role, and then now today he's an independent quant. But there is a lot of effort that went in. 1,000+ hours a year. We were sitting down and calculating because he was, let's say, on evenings, on weekdays, and on weekends. Every year he was building his own strategy on the side. So he did that. He at least spent 1,000 hours a year. He spent at least 5 years building his own strategies. He learned a lot of it alone by making his own mistakes. And when he looks back, he thinks that it would have been great if I had somebody who I could reach out to who could help me. Right. And that is also something that we want to provide to people. I think it's very valuable if people don't have to go to 1,000 hours per year, 5 years of effort before they can actually build their strategies. And a lot of that can be drastically brought down. So that's the story. It kind of summarizes the 3-hour webinar. If you want, you can still watch it. You should watch it. But if not, I think you got a big part of it. It also answers some of the questions that you guys fed in the forms. Thank you for listening. We will start a live Q&A. You can connect with us on LinkedIn, Instagram, Reddit. You can email us. You can also check out our website. And you can also spread the word. You can let other people know. And if somebody wants to work with us, get access to the webinar, if they want to get on consultations with us, if they want to get invites to meetings like this, they can register at quantyog.com/register. So with that, I would like to start the live Q&A.